Sharestates borrowers are constantly looking for old houses to purchase.
It's going to be these 4 buildings, 1, 2, 3, 4.
And then to sell after renovation. This fix and flip investment style can offer high returns.
When this building is done, it's going to be worth roughly $4.5 million at a $2.3 million cost.
In this video, we will visit the location of one of Sharestates' latest investment properties.
I don't want to fall in.
To discover how this investment style can offer high returns. Today we are here in Brooklyn, New York to visit a building in the process of renovation.
We're in the Bed-Stuy neighborhood of Brooklyn. Sorry about all the noise. We're doing some work. So we actually picked up this property about 4 or 5 months ago now.
Okay.
We're in the process of converting it from a church as a prior use into a mixed-use building.
The building is a total of 10,000 square feet, 4 stories tall, and includes a basement. It will be transformed into a mixed-use property, featuring a business area and 11 apartments for rent.
It's rare you can acquire something from a church, right?
Yeah, so, with churches, it's a little difficult because you have to actually go through the Attorney General to get approval to convert it from a church back to any other use. We got really lucky here because the building actually had a certificate of occupancy already for a mixed-use property.
Okay.
So it made the process a little bit easier for us.
Although Sharestates can begin construction quickly, the process is far from simple.
This, whenever you see bricks over here,
Goes down?
it over there goes down. Then have glass,
Oh, okay.
like a storefront. Everything is
Oh, okay,
storefront.
I got it, okay.
So once the beams over here are completed, we're going to have a metal staircase that's going to go from here all the way up through all the floors.
Stairs, windows, floors, the balcony, and basement all must be renovated.
I don't know what happened over here, but years ago, this is already under the sidewalk.
Right.
This is not part of the building. This is like extra.
Really? Well, you can use that for another apartment.
To make the projects run successfully, Sharestates has ongoing collaboration with its vendors.
You cannot sleep in a cellar.
Though this project requires a large investment, return to investors make it worth it.
We pick up the property for roughly $4 million, do another $1 million worth of renovations. And when we're done with this project, the building should be worth somewhere around $7.5–8 million. So we'll be able to refinance, pull out all of the equity that we've put into the property, and basically hold the building for free.
1 year ago, Alan and his partners established Sharestates. The company used a private placement method to gain money from individual investors, and then used that money for renovation fees.
We're letting investors go direct to the borrowers through a platform like Sharestates. And they can actually individually pick and choose which borrowers and which properties they want to lend to. And the borrower will actually hold the paper to that loan directly. So they have more transparency, and they also have the benefit of the higher interest rates. So instead of making 1% or 1.25% in a CD, you can make between 10 to 12% on your investment.
It's really big,
with monthly distributions. And typically you'll have a shorter lockup period. So in a CD, your capital could be locked up for 18, 24, 36 months. And our projects, you're usually in there for about 12 months.
Sharestates has grown financially stronger due to its extremely short investment times. The largest project operated by Sharestates thus far has reached a financing amount of $100 million. That project featured 460 single-unit houses.
We want to build a one-stop shop where we have a seemingly unlimited amount of capital, access to capital. And our borrowers can come on and have a better experience, similar to how they would have with online banking. So they can come online, apply for their loans directly online, even apply for equity financing, and then be set up with a portfolio that'll actually track those different investments and different loans with them. So they could do things like setting up auto pay and receive notifications for when their payments are going through and being processed. And likewise, for the exit process, they can actually go right online and request a payoff for their loan.
This is another fix and flip project operated by Sharestates, in which this 4-story building will be transformed into 8 rental apartments.
The partner that we're working with is converting into 8 different units.
Okay.
So we're going to have 4 duplexes and 4 simplexes. He bought the property for roughly $1.35 million. It has another $1 million in rehab. So the total project budget's actually about $2.35 million. And we gave him about 70% of his financing on this project as a private loan.
Okay.
So the borrower is working with us. He's paying us, I believe, 12% interest on the loan that we have with this property.
Are they gonna keep the wall like this?
I think they're going to keep the walls exposed, yeah.
Actually, it's kind of nice. I like
nice,
that.
yeah. I'll have to touch it up, but it's going to be exposed brick. This is one of the simplexes, it's single floor. It's one bedroom, bathroom, and then a living area. I believe this unit's going to actually be one of the duplexes. So you've got the same bedroom, bathroom, kitchen area, living setup. And then over here down this hallway, I believe is where we're going to have a stairwell that will lead up into the second floor.
Okay.
Due to the large size of the construction project and the resulting high amount of investment required, Sharestates chose to finance this two-house renovation project through equity investment. Investments can receive a 20% to 40% profit, but the risk involved will also increase.
In those equity projects, there isn't any immediate cash flow. So an investor would have to actually wait until a project is fully completed before receiving their return on investment and their principal back. Whereas with the debt product, they'll start seeing distributions almost immediately.
From a risk perspective, there are typically 4 investment strategies. First, there is senior priority debt, whereby investors are paid first and generally reap from 10 to 12% return on their investment. Secondly, there is mezzanine debt and are paid after priority debtors, which returns typically from 13 to 14%. Following that are preferred equity and common equity, which are the most risky because they are not based on fixed rate of returns.
And then once you get into preferred equity, you're moving into the third part of the capital stack, which is going to give you a little bit more exposure because you do have 2 positions that are going to be ahead of you, but you also have some sort of equity upside. So what will happen is you'll usually have some sort of a fixed rate of return that's associated to the project, which will be smaller, something in the ballpark of 6 to 8% annually. But then you'll also share in a percentage of the equity upside in the property as well. So that could look like a 6 to 8% fixed return plus 35% of any additional profits that come through, which will usually bring your overall return, depending on the project, between 20 to 25% annually. And then in the fourth position of the capital stack, you have your common equity, which is going to be the riskiest position. And those are usually the investments where you're going to have the most risk because you're in a first loss position. So if you don't hit your target sales dates, if you don't hit your target sales prices, let's say we're talking about a condo project, all of the other investors are going to get paid back first. Your senior debt, your mezzanine debt, and your preferred equity. And then the common equity investors could potentially lose, but they also have the highest upside. So if you're looking for a very aggressive investment approach and you're more concerned about making 30, 40, 50% a year, common equity is a great place to be, but it comes with its risks.
In the last few years, Sharestates' market and in-house renovation program has expanded nationwide. They are now lending in over 45 states and growing, having taken on over 600 loans in total, a number that grows by the week.
We're focusing on markets that had the potential for a lot of upside, but they're also still secure. So Brooklyn is where Manhattan was from a pricing standpoint 20 years ago. It doesn't matter where you buy in Brooklyn today, aside from maybe East New York, but in most parts of Brooklyn, if you buy today, within the next decade to 2 decades, you're going to be sitting on a gold mine the same way that people did 20 years ago. A lot of these people moved in here and bought these 3 or 4 family properties, these brownstones for $200,000-$300,000 back in the 80s and 90s, and they're cashing out today for $2 or $3 million a piece. So there's still a ton of upside here. I think if properties in Manhattan that are similar to these can get to $8, $9, $10, $11 million a piece, there's definitely room for these to grow from the $2 to $3 million range that they're in now to at least $6, $7, $8 million a piece within the near future.
Sharestates has had an exciting few years with record growth and investment, quickly expanding beyond its New York roots to become one of the industry's most respected and well-known real estate lending and investment platforms.